Before we get started, I just want to remind everyone that this information discussed today is not intended to be or construed as investment advice. Please consult a professional advisor before putting a loonie in any of these financial markets.
The dirty secret is that no one's ever going to get paid back.
People have the shortest memories when it comes to investment.
We just got to get Keith into Bitcoin.
Hey, there's a bubble. Welcome back to Loonie Hour, episode 96. As always, joined by the three amigos. We got Keith Dicker, IceCap Asset Management, in his bright red t-shirt, and Rich Diaz, the Tom Brady of macro. Welcome back to the show, gentlemen. What's new, Keith?
It's funny, I was thinking of, they call this the dog days of summer. Didn't we use that as well? And so, that reminds you of baseball, of course. So I was thinking about, and Rich is in Montreal these days. So it reminded me of the Montreal Expos. So you guys don't realize, but they were a good baseball team, a while back. But they had this, you guys may not know this, but back in the 80s, and they had a bunch of rock stars playing with them. And but they had this one peculiar relief pitcher. His name was Bill Lee. His nickname was the Spaceman. Do you know that name, Steve?
I know that name.
I don't know.
So, yeah. So anyone, listeners, some of the older people might say, oh, yeah, I remember Bill, the Spaceman. And for those of you who may not be aware of the story, but, Bill liked to have a few drinks, like before, during the game as well. But a number of times he'd actually be at the bar that's 2 blocks away from the stadium. And he's at the bar having drinks and he's watching the game on TV. And then he says, they're calling the bullpen for him. So several times they're on the mound waiting for him to come in from the pen. And he actually comes out from the dugout. And they're saying, oh, that's weird. Where did he come from, I wonder? But that was Bill Lee in the dog days.
There's no way that's a real story.
Oh, yeah. This guy is legendary.
Well, it was the 70s.
He's from Colorado. Was he California or Colorado?
Was he good?
He was pretty good. He's a left-handed pitcher. He's pretty good. I think he was
pretty relaxed all the time.
He pitched in the World Series with the Red Sox, I think, actually. If I'm not mistaken.
It's kind of like one of my other favorite pitchers is Nick LaLoosh. Do you remember him?
No. Is that the guy with the mustache?
He was the Tim Robbins character in Bull Durham. So he was a bit wild and flaky as well.
That's a movie Steve has definitely never watched.
Yeah. Speaking of wild and flaky, what's our wild and flaky Rich doing there today?
Oh,
you need some color, man. Like your background is white. You're wearing a white shirt.
I wasn't going to share this, but it was my birthday on Monday. So I had a very, very chilled out birthday. And yesterday I went on a date.
Any special lady friends?
No. Well, I'm telling you, yesterday I went on a date with a girl to a pretty good French restaurant in Montreal. I won't give them a shout out because it wasn't the best service, but the date did not go so well, but that's okay. We're back. We're trying to get back on the horse here. So Montreal, the Montreal dating scene's been pretty slow, but which it shouldn't be because it's summer and everybody's out. But maybe I'm working too much.
So how did you ask her out? Yeah, what did you say?
It was a friend of a friend. It was a friend of a friend. It was a friend of a friend.
You had to go the friend of a friend route?
Yeah, no, it was a friend of a friend. We bumped into each other at a party and he said, hey, do you want to go for dinner? And so that was it. We went out for dinner.
So she sucked, basically, is what you're telling me.
No, I wouldn't say that. I don't know if she lives here permanently. It's too complicated. I'm getting old. Maybe I just need something simple in my old days. But there you go. That's the news flash on the Richard dating scene.
I met Mrs. IceCap at 3 a.m. at a bar. On a Tuesday night.
Man, you're like Bill Lee.
And the lights are
like
down.
Bill Lee, Spaceman.
Slugging back down. Bud Light.
Yeah, they weren't Bud Lights. Steve, and what's happening in Kitsilano?
Not much. Dog days of summer. Housing markets, I don't know, weird, slow. I think prices have leveled out for this little blip here that we had in the spring, and we'll see what the fall brings. Everybody's kind of just sitting around waiting to see what's going to happen. But other than that, trying to watch, see what things might influence the markets moving forward here. Obviously, we had a the dog days of summer, as you say, but I think we had some key data points this week: US CPI, China CPI. We got some movement in the bond yields, Italian banks, etc. So it was a decent amount to get through this week. But Rich wanted to tee it up here. Now that you got the Bloomberg terminal, US CPI. So that came in today, pretty much like right on the screws.
Well, I'm happy you said that because I can't do my Zoom call and the Bloomberg at the same time. So I don't actually remember what the expectations were, but I do have the release in front of me, which is good. So it rose 0.2% in July, which is, I think, important. I think that's the second month in a row it's 0.2%. So what is that, an annualized rate? 12 times 2, 2.4. So that's a pretty good number. I think what I thought was interesting was that actually the headline rose slightly to, what is it? 3.2%. So there you go. Food is 4.9. I think things that we always talk about a lot, which is obviously core, which is, it's 4.7. So core continues to like slowly get lower and lower. I think shelter, I read somewhere that shelter accounted for 90% of the increase, which is something we've talked about a lot. I think we're not going to, I don't know if we should go over too much, but what I want to say is a couple of things going forward is to look at the energy prices. So energy prices, obviously, are energy component of the CPI basket. Can't remember exactly what it is. I think it's 11%. I think it might be a little bit lower in Canada, or maybe the other way around. Anyways, the point is it's non-trivial, but it's the volatility that matters with the contribution, and we're already starting to see sort of the base effects come through. And so now we're going to, because I think an energy price in the US, I know that it's true in Canada, are actually going up. We saw these Saudi OPEC cuts from a couple of days ago, if I'm not mistaken. So the OPEC is the organization of petroleum exporting countries. Yes, I got that one. And obviously they control about, I think, 30% of global oil production. I think that's way down. In the 70s, it was, or 80s, it was much higher, closer to 50. But obviously, since the US and Canada and a bunch of other countries have started producing more oil, OPEC is less important. However, they do matter at the margins. And so they announced that they wanted to cut, and they've been doing that. And we know that the oil curve is quite flat, meaning that years and years out, oil prices are basically what they are today, which is because of supply constraints. You can try to figure out why there's supply constraints on your own. I'll skip that one for today. But basically, we're seeing energy sort of perk up, and I think it's going to flow through to inflation. We talked about sort of that feedback loop before, and then the shelter. I'm looking at one note. I'm going to start. Maybe I'm going to write about this week, which is the shelter component and rents. And we're starting to see, yes, rents are coming down year on year, but again, those numbers are starting to slow. We talked about vacancy rates; they're really low, and so we're going to see that going forward. That was it for me on the CPI thing. Keith, did you want to add anything?
I've got some comments, but Keith, go ahead.
What were your comments? What do you have?
Yeah, I want to know.
Well, no, I think like before, like, we really like get into this CPI stuff. I think we should put an asterisk next to this, that I find the exhausting thing with like discussing inflation and CPI is like the amount of vitriol that comes out around the prints. Everybody goes, if they don't like the number, they say the number's fake and made up, and yeah, but it's base effects, and inflation has destroyed a lot of, like, everybody knows this. I just think it's important, like, when we come in and we're discussing, hey, listen guys, like, inflation came in a little bit below expectations. If you analyze or annualize it, it's 2.4%. No one's denouncing the impact that inflation has had on a huge cohort of society. It's just, we're trying to look at this through a central banker's lens, through a market lens, and saying, okay, what is the trajectory from here? Because I just think, I honestly, I've actually stopped tweeting about like it's CPI, because it's just, as soon as you tweet about it, you just get all these comments, and just people just like rage fit. I don't know if you noticed that, but
I don't know what a rage fit is, but I like it.
it's honestly exhausting. It's just, I do think like it's interesting, because I feel like inflation and like the CPI is definitely politically charged as well, right?
Well, yeah, it is.
it's
I
politically
mean,
charged. I mean, if you're
I think that was
more,
really good context that you put it, Steve. Thank you. You're right. I'm happy you said that.
to be honest, if you're a little bit more right leaning, you tend to get a little bit more fired up about CPI prints.
I mean, this decade, I mean, in the past, inflation's been really a central bugbear of the left. So I think people, adding to some more context, I mean, inflation really hurts working class people. The left wing used to care about working class people. If you're right wing, you're generally probably an asset holder. You own lots of equities. You're generally more or less insulated from higher inflation. But those are obviously quite broad strokes, so don't at me. But Keith, I don't know, you're going to jump in there.
I never look at it that way. I see your points. I just see, from a market.
What are you looking at it just from a portfolio management perspective?
Yeah, I see it more from a market cheerleading perspective. So, I mean, markets are inherently bullish. That's the way investors are in general. So they'll always try to find a reason to be, to see dovish data in because of where we are right now, for example. But like this morning's number, I mean, I was chatting with someone and they said, what do you think? I said, well, I think if you squint, you can tell it's dovish. And, numbers are getting a bit better here. They are trending lower. They weren't they were mostly equal to expectations. And so what that means for everyone, like if inflation goes from 4% down to 2%, that's the number. What the market really looks at is, were analysts expecting 2%, or were they expecting 2.5 or 1.5? So, we just tend to look at it, hey, from a market perspective, what's happening here? So right now, the theme this morning is that, hey, now the Fed can pause in September. We can take the rest of August off. Markets aren't really trading that way. Like they're a bit volatile here this morning. I think the S&Ps had 1% round trips already here this morning. Currencies are all back now lower than the pre-data point when it came out. And so overall right now the markets are saying, hey, the Fed will not raise rates anymore. And in fact, I think Rich will now see on his new Bloomberg terminal, they have the Fed cutting rates by 1.5%, 150 points by January of 25.
A long ways out.
Yeah, that's not going to happen. That's too far out. But that's what the financial markets are showing. Anyway, so like when I see this now, you mentioned commodity prices. Was it you, Steve, or Rich? One of you did.
Rich mentioned it. I do have some comments on. You get to it first.
Yeah. So, I mean, I don't go into the granular detail, where's the number coming from and stuff like that. But what I do know is, those listening to us, we've been anticipating commodity prices to trough or bottom in the first half of this year. And now it seems like that has happened. It took a while to do that. Now they're all starting to trend higher, especially oil. And that should start to show up in general prices now, maybe end of August into September. So there could be a bit of a, maybe we're getting closer to this bottom in CPI. I know before they talked about maybe, 3 is the new 2%, things like that. But I know, Rich, you've said before as well that, inflation will not, go all the way down to these depths that, some people are talking about. Now, I do think we can get there. Remember that panda in the room, narrative we're talking about. If China does implode, we'll cover that as well. That's going to create some real great opportunities coming up on the investment side. And but that's what we see there right now. So, for example, another story I saw this morning, I don't think it's affecting the American CPI. The hell is it? Oh, here we go. Soaring rice prices stretch budgets for billions in Asia and Africa. Mm-hmm. So we know wheat and corn, the soft ags just shot up recently. Most people follow, oil and maybe nat gas to that extent. But now rice prices, like they're surging over in that part of the world. So that's something else, again, it's a global phenomenon that we're looking at. And if it affects that part of the world, it'll affect other areas as well. What were you going to say? I think it was Rich.
Yeah,
Steve?
I mean, I think we should almost do like a segment here on commodities, because I think that's gonna. I think there's some big macro themes that are happening, I think, in that space. But just to touch on the inflation side, because one of the things I look at obviously is the shelter component, which I'm heavily involved in here, obviously. But if so, inflation, so 90%, Rich, you were right, 90% of the CPI sort of increase for this month was basically just shelter. So again, hypothetically, you stripped out shelter, you'd have inflation back below. So if you strip out inflation, CPI came in flat in July and has shown no net change at all since March. The year-over-year trend here is 1%. And then that would have peaked at 10% a year ago. But basically the shelter component in the US, again, it's tracked a little bit differently than in Canada. The shelter component in the US, the way that CPI tracks it, it lags by about 12 months, which, I mean, that's a huge lag, right? So if you look at like asking rent, so if you go on like, Zillow or Redfin or any of these sort of like public sites that are tracking like asking rents in the United States, asking rents have topped out. And in fact, in some states are actually declining. I don't think that the rental market in the US, at least from what I gather, is experiencing the same sort of tightness as we're seeing here in Canada. Again, obviously Canada, you're adding 1 million people a year, an inability to add new housing, a little bit of a different story in the US. And so the argument is basically, well, like, listen, if shelter is driving a large component of inflation today, and they're using a rental metric that lags by 12 months, how's that going to look? And so anyways, that's, I just, to put that out there, I think to overlay it with Rich and Keith, what you brought up, I think definitely, the one wrench in all of this is going to be the commodity space. We've seen obviously what's been happening, particularly in oil and gas in the last month. Food prices, due to, I think, extreme weather events in large parts of the world is
also, but it's also policy. So India, I think, I can't remember, you guys will correct me if I'm wrong, I've screwed this up maybe, but one major rice exporter just banned them. That was one of the reasons why rice jumped, right? So that they were worried about sort of the supply for over the next little while, and then they basically banned rice exports. And rice is the most important crop in the world. We talk a lot about, I don't know, it's as popular in Canada, but corn, obviously very important with all the sugars and stuff like that. Wheat is very important. Bread, potatoes, one of the most important crop. But for most of the world, rice is the most important grain. And one of these countries, damn it, I forget. Shit, sorry, this is bad podcasting. I should have had that prepared. I think it was India or Indonesia basically banned the export of rice. And I think it was India. So India caused one of the futures indices to pop basically yesterday morning or this morning. Sorry, Steve, keep going.
But Keith, you've had a good call on natural gas. I think you've been bullish on that for a couple months now.
We've been building a position in nat gas over about 5 months, maybe. It's extremely volatile. Is that one of these, it's a slow burning fuse. Like, you're getting daily volatility of 3 to 5%, which is pretty big moves. So I know some people try to trade nat gas on a daily basis, use some of these levered ETFs. And, the thing with the investment, when you're right, you attribute it to skill. And when you're wrong, it's, oh man, I got bad luck on it or something. But for us with nat gas, so using the US dollar benchmark, we targeted 2.25 as being basic, the trough. That's where it should be. So we were buying a number of different tranches around that level, and now it's done well. And same with oil as well. So we've been building up oil. We do hold rice indirectly in one of these ETFs that we hold. And but it's all moving, which I think will come back to play now in the inflation story later the year, because inflation expectations now for for the West, they're all like shooting straight down. We have this linear perspective, linear thinking. If it's going down, it'll continue to go down. Just as a year ago, no one thought inflation would ever stop rising. And of course, this is where Rich would say, well, technically it's still rising, but it's not
It
as
is still
fast.
rising.
Yeah, no. Did you guys see the article? And I don't know which paper it was, but they said inflation is now collapsing, and they said it's gone from 8% to 2%. Like it's falling. I'm like, no, it isn't. It's
CBC.
Still going up every month.
Could have been. It could have been the CBC. But
CBC.
so we need to watch Europe as well, because inflation expectations for Europe, it's shooting way lower than what the ECB is targeting. So the chances of the ECB obviously become less hawkish, that could happen as well. But at the same time, I think nat gas in Europe just shot up dramatically this week.
Yeah, it was 40%, didn't it? It was
Yeah,
it was the Dutch. So natural gas is traded different prices and different qualities, obviously, and quantities in different countries. There's the UK, Netherlands, obviously the US, etc. Not Canada though, because there's no business case there. But in the Netherlands, I think it was the Netherlands one, right? That they shot up 40%, Keith?
I think you're right, Rich. And, the challenge with energy prices, raising rates up and down doesn't, increase or decrease supply. But Europe, I think Europe is, they're screwed more than the Japanese, maybe, but not as much as China. We'll see. Do you
remember that story though? Like the theme last year was that like nat gas prices were like mooning, and everyone was like,
mooning means going up, right?
People in Europe are going to freeze to death on the streets, dark winter. And obviously, I think they obviously had a warmer winter than usual. So maybe
it was going to be a winter of death. No, that was for COVID. I take that back. That didn't happen.
It just keeps rolling through.
I know all those shots we took that helped with the winter of death.
Anyways, back to the natural gas.
No, but
with Europe, though,
like,
the winter was more mild than they were speaking. And
is that story going to come back?
I think it will. Yeah, I mean they filled their their hats to the brim. Yeah, with gas, and now no, they were okay. They got lucky with the weather. But we'll see where we go now.
We'll see if they get lucky again this time around.
Maybe.
But where inflation isn't going up. In fact, we actually have deflation is in China, the world's second largest economy, officially exporting deflation. So China CPI year over year came in at negative 0.3%. And China PPI producer prices fell 4.4% year over year. But expectations are of 4%. So yeah, I mean, outright deflation in China. Kind of curious, again, how much emphasis you guys put on this. I know we've been chatting quite a bit about the panda in the room, but it's pretty interesting to sort of see, like, the Western world obviously having this inflation problem, and then you've got China actually dealing with deflation and concerns again over a property bubble that they're struggling to bring back to life.
So, Steve, you're turning into a real good global macro guy here. You're saying inflation grew minus 4.2%. Yeah,
I don't get it.
That doesn't make any sense.
I know, that's the way the world is. Inflation grew by a negative number. Did
I say that? Well, we had outright deflation.
No, but that's what the media presents it. Anyway, maybe I'm just really.
Prices
funny.
are falling in China. That's what you need to know.
I'm funny during the dog. I'm the spaceman today, right, Rich?
Yeah, I guess so.
Okay, maybe. Rich, what is your take on the China inflation story?
China, I hate extremes of views. And I think all the doomsday sayers about China, I think, have maybe got it wrong. However, in the short term, there are some clear negative things going on there, and I think you can't deny that. One is just overall the goods export cycle that we saw over the COVID and post-COVID months, that's basically petered out. Two is, you're right, Steve, the real estate stuff. So, we think we had a real estate bubble in Canada. Well, we did. And the similar thing was happening in China, basically throughout the same time period, which is People were just plowing an incredible amount of money into apartments, apartment buildings, houses, homes, whatever you want to call it. I don't know. Did you ever hear about these ghost cities? I mean, at least in Canada, we know that there's population growth going into these homes, going into these areas with inflated house prices. In many cases in China, there were basically a lot of this money was plowed into cities that were called ghost cities. I'm sure that's a bit apocryphal. But then the third thing I think, which we're going to speak about more and more as we go on, is basically this bifurcation of the U.S. and China, which is that people are trying to shift their production facilities, their semiconductors away from China. And I think that the fourth thing, you don't like my lists, but is the employment number, which you guys sent me a chart over, and I didn't believe when I first saw. But China's total employment peaked in 2014 and continues to fall as they just they have horrific demographics. Keith, I'm sure I missed something, but
the important thing too, right? Like zero. I mean, there's no immigration.
Right. Oh yeah. Well, I took that for granted.
Well, I know. I think a lot of people sort of paint again, right or wrong, could China potentially be like the next Japan, right? Like huge real estate bubble, no immigration, aging demographics, and now they're left with the hangover.
Definitely. The parallels are definitely there.
Rich, why don't you explain that employment data point you just referenced?
Yeah, sure.
Employment declining.
So, I mean, basically, the chart that you sent me was just total employment. So there's been a lot of talk about demographics, and there's two ways to look at demographics. One is the total number of people you have. And then the other is the number of people who are able to work. So you think of like active population, or you think of participation rates as a sort of an offshoot of that, or you look at ratios like employment to population. But then you can also look at sort of something called an age dependency ratio. And again, there's different ways to calculate that. But one way is to see like how many people are able to work versus the number of people who are dependent on them. Straightforward. So you've got young and you got old, and you've got the prime aged workers sort of in the middle, in that belly. And the problem China has is sort of twofold. One, it has kind of terrible top line demographics, which means that the number of people that are just exist in that space are going to shrink. If I'm not mistaken, it already started to fall. And then the second problem, which I think is probably more important problem and more acute, is the number of working age people relative to the number of dependents. And that number basically, it's just that China's getting really old really quickly. And there was always an expression, you want to get rich before you get old. And unfortunately, China, and that people mean that when they talk about middle income countries, low income countries. And so China's really was trying to get rich before it'll get old. And then I think if you look at these demographic numbers, Keith, they're getting old before they get rich. And that's a big negative impulse on growth, productivity, savings. And it has loads of repercussions, which this is where macro sort of trips itself up. It might take years and years and years to play out. So I think the emphasis on that in the near term might be overstated. But Keith, I think that's sort of the roundup for that.
Well, you're already rich, so you're okay. But the thing that jumped out with me with the employment chart is simply showing the total number of people working in the country. And if I get the numbers, but as you said, like it literally peaked in 2014, I think.
Yeah. At 763 million people, 100 million.
763 million people were working there. It's just,
and now it's 734.
Amazing number. So in Canada, what do we have people working?
25
million, 20, something like that. Yeah. And so now that number in China, it's been declining, ever since. The trend started going lower, and it can't rise again just because of the way, the demographics are working out. But the other interesting, by the way, so you don't like, the extremes with, everything just on fire and doom and stuff like that. I'll take the other side. Steve's already smiling. China's doomed.
This is like the YouTube clickbait headline here. China is
fire
doomed.
in the background.
Market crash imminent. Get a lot
Sorry,
of
I need to interrupt you before we go on. There's one huge thing that I forgot to provide context here. I apologize, Keith, which is the reason.
1 or 28 points.
No,
How many
one,
points?
I swear,
just 1 point. Got it.
And it relates to the one-child policy. So people say, well, why is Chinese demographics falling off a cliff now? Between 1979 and 2015, they had something called a single child or one-child policy. And so basically, we're just not allowed to have more than one kid. And you need at least a 2.1 children per family to have a replacement rate. Keith, sorry.
I don't know where I was going to go after that.
You were saying China was doomed. You were saying China
no. But I think people need to appreciate why China had this boom. So I mean, the population was growing, of course, that was very big. Everyone rose with the tide because of globalization, all that. But one of the key levers that really helped China to sort of catapult itself, into the economy that it's grown into, one was the ascension to the World Trade Organization, WTO, 90s. I forget when it was. Yeah, and then they also MSCI. They also then put China into their equity indices. So then that enabled Western world capital in the equity world to start. So you had money of investment money capital flowing into China, and then all the Western companies were trying to go in there directly as well. And then on top of that, China started to create debt. So they started borrowing more and more. So it was just fuel on top of fuel on top of fuel to let it do that. Now globalization, I say it's dead, and Stephen Rich, you guys will say, well, it's not dead, but it's just not as global as it used to be because people are, nationalization is coming back online. The debt story has probably run its course as well. And then you have, people are leaving and things like that. So I think it is going to be a struggle for that part of the world. We reference the panda in the room. But when it comes to demographics, I think Canada, we're okay. I think the Americans look awesome as well. Mexico was probably number 1 in the world, something like that. So it's just something to think about longer term, which way capital will flow. But when you get in these big debt challenges that we're experiencing today, it's something we need to look at. And I know you reference China compared to probably the next Japan. What would it be for Japan in the room? A dragon? Like, what would it be?
No, China's the dragon.
No, China's the panda.
Oh. Japan would be baseball player?
Steve has no interest in this stupid conversation. He's totally tuning.
The fish in the room?
The fish in the room?
That makes sense.
I don't think it's the fish in the room.
Something stinks.
We got
no.
Yeah, the Loonie Hour.
Yeah, just so people don't know, Steve doesn't eat fish because he's a Philistine.
I grew up in Steveston, which is a fishing village, and I do not eat anything from the sea. But
refined for food stuff. Anyway,
just to wrap up on the China stuff, some crazy data. Chinese exports plunged 14.5% year over year in July. Imports down 12.4% in US dollar terms. So exports to the US fell 23%. So I don't know if you can chalk that up to like a partial re-onshoring of supply chains, but I think also just that has to be also just the demand picture as well.
It's not just that. There's FDI numbers that if you come out that are really weak, and then there's one more that I forgot. Sorry, which is the PPI, which you often talk about. Sorry, Keith.
Yeah,
but it also shows. I mean, like China exists because global trade is strong, and when it's weak, what's happening now? It means there's less U.S. dollars coming into the system, and when they have less U.S. dollars coming in, it means they need dollars to run their country, their business, to meet outflows and stuff. And if you look at their treasury holdings, you see that they are declining. I haven't checked for a couple of weeks, but I assume they are still declining. And some people say they're selling the treasuries because they're afraid of the US and debt downgrade and nonsense like that. They're selling treasuries because they need US dollars. But the export-import data coming out of China, it's incredibly important because the trend continues to deteriorate, and it really is a barometer or measurement of global growth. So we keep going back to the Western world, like in the US and Canada as well here. Where are we going with our economy? And if you're bullish on the economy, we need China to do well. We want them to at least remain stagnant. And as of right now, that's not the case. But moving over to the fish in the room here for a second, that's not a good one, Steve.
No,
we need
it's
something
not.
better than the fish in the room.
What about cherry blossom? The Japanese cherry
Yeah,
blossoms
no,
are
this is
beautiful.
Horrible.
That doesn't work either.
You ever get a chance,
find-
if you ever go to Tokyo or Japan or Kyoto, I mean, they're really famous for their cherry trees. And for like 2 or 3 weeks a year, you have an entire section of the city that's just pink and beautiful, full of petals and stuff. It's quite romantic.
Can you hear it, Rich? Can you hear my snap?
Oh
I got it. The ninja in the room.
Okay, I like it. The ninja. Nah.
I don't know, man. You can't.
There's some cultural tropes we're gonna get in trouble for.
You're getting canceled. Anyway, the ninja in the room here. Japanese yen is now back to a level reached in 1987.
Wow, that's
So
amazing. Really?
Yeah, it's getting mullered, absolutely mullered. And you can't think of it as conditions today are the same as back then and so forth. And people say, yeah, what's the word they say when people short Japan? The widowmaker, I think they call it. The widowmaker trade.
Another culturally insensitive reference. Carry on, Keith. You're on a roll.
I'm on a roll. Yeah, boomer. The challenge with Japan, I think we talked about it last week. I think when Brent Johnson was on the call with us as well. Like they're capping they have yield curve control, so they are preventing yields from going to a proper rate and to have price discovery in the bond market and so forth. And because they have to save the bond market, it means by default the currency market gets left wide open, to reflect risk. So even here today, with every currency is green today. The pound is flat, but yen is getting hit hard again here right now. So so again, like China and Japan, they sort of go back and forth. They compete on a lot of things. I heard a real juicy story about Japan and China, which I'm told I'm not allowed to repeat on air, so I won't. But
that's a real teaser.
Yeah,
I know it
on
certainly
that.
is. Yeah, it certainly is. And don't email me and stuff. But there are some real big things happening. And I know we've been talking about China quite a bit over the last few weeks, but don't forget the ninja in the room.
Just one more thing on China. I think, sorry, just to push back against this doom and gloom. China is like the largest trading partner for most countries in the world. It is an enormous economy. It is the largest economy on a purchasing power parity basis, larger than the US. Yes, that's true. You can look that up. And it has a massive current account balance surplus in the sense. So it is still, there are ways that, if it lowers its, for example, if it stops pegging itself to the US dollar, I mean, you could talk about capital flights and, whatever. It already restricts those things. So, it to boost its exports. It is a command and control economy. I'm not a super big fan of that. But when you're dealing with deflation and debt deflation and assets that need to be written off, it's really useful? Having an authoritarian dictatorship in order to execute that plan where you recapitalize the banks and steal money from people in order to deal with sort of debt issues and debt deflation. So
you sound like a Western leader who said a country they admire the most.
No, how dare you? I would, shame on you. That's the meanest thing you've ever said to me on the 96 episodes of the Loonie Hour podcast. My point is that there's definitely some problems there, but this idea that they're just going to sit idly by and do nothing about it, I think is wrong. But anyway, sorry, I had to push back there.
Well, yeah, and then like I said, I mean, they still got the real estate bubble that they're working through. So remember there was like the huge Evergrande story with the property developer basically defaulting on all their bonds there. So right now we're dealing with was it Country Garden, I think, is actually China's largest developer by contracted sales. So the company's dollar-denominated bonds maturing in January of 2024 are trading at 25% of their notional value, compared with 81% as recently as mid-June. So there's sort of a free fall in Country Garden debt, which is again sort of the panda in the room, which it's interesting, right, Rich? I don't know like how much you overlay this, but like I know like a lot of the narrative like 12 months ago, like as China was reopening, there's just going to be this huge surge like we saw in the Western world, right? Which is people getting out, being active again, spending money on services, traveling, all this pent up spending on services. And it seems like that was like the narrative for China as well. However, after having been locked in their homes effectively for 2 years, and we just haven't seen that. And we haven't seen the real estate market come back to life there either.
The real estate market, I think, is busted flush. So I think I can't add too much to that. I think I would be careful to downplay the spending on certain products. So if LVMH, which is Louis Vuitton, Moet, and I forgot the other one. Oh man, acronyms. Anyway, so LVMH is one of the largest companies in the world. Its owner is the richest person in the world. They sell all kinds of luxury goods and products all over the world. I mean, they've had a great year. So, I mean, you have to, and a lot of that, and most of their revenue and most of their sales comes from Asia, if I'm not mistaken. I think it's like 40% comes from Asia, ex Japan or whatever it is, which is basically China. So you have to be very, very careful about that. Also, there's the travel. I think you're seeing the group bookings. So in China, they do a lot of group tours, sort of like it's a harbinger of like the United States from the 60s and 70s, and the Japanese from the 80s. So a lot of group bookings and stuff that's doing relatively well.
They do the Vancouver real estate tour.
Yeah, well, I mean, sure, fine, but they also go to places like Italy and France and what have you. So I think we need to be careful. But I also think, just more generally, I think that the scars of being shut up and shut down for as long as they were, I think are real. And I think we often sort of discount that behavioral economic portion of it. I think I know a friend of mine who lived in Beijing, who was locked in his apartment with his wife and dog for 77 days. And the first opportunity he had to leave China for good, he took it.
And who did you feel worse for, him or the dog?
The dog learned how to use the toilet or what?
I didn't ask him that. I didn't ask him if the dog learned how to use the toilet. But my point is that I think we're watching like what happens when it's the scars are deep, and I really feel sorry for those people. They didn't deserve it. Keith, maybe I'm getting soft.
Well, Keith, I'm kind of curious your thoughts on like a market perspective. Just like, how do you personally feel like the markets are maybe brushing this story aside in terms of the global growth outlook / you can circle that back to inflation, obviously what's happening in the bond market, right? I mean, we've seen a lot of volatility in the bond market, but still, yields are pushing higher over fears of, soft, or not fears, but optimism around soft landings and, no real issues. But then, like I said, meanwhile, you look at the second largest economy in the world having some issues.
Yeah, I think the market is wrong. Equity markets are wrong at this point. I think because they've always been trading now. It's really odd because for about at least a year, they've been trading on the expectation that the Fed has stopped raising rates, and that's deemed to be positive in the equity world. And then that gets reset the next month after the Fed meeting, and then they dance in and out, and then all of a sudden, nope, one more month, and now they're done. So equities have been going higher on the expectation that rate hikes are going to end. I don't think they're going to end yet. I think they'll continue to go a bit higher. But overall, I think the second half of this year, there's an opportunity for equities, to go in the opposite direction that we had in the first half of the year. Especially a lot of these AI related, companies. There's, you've probably seen the charts. You have the S&P excluding those names, and then just those names. A bit of the what do they call it? The alligator chart. Is that what they call it all the time? The alligator jaw. Yeah, the mouth is opening.
Boomer doesn't like the AI stocks.
Yeah, I don't. It's like, what was the stuff you guys liked a few years ago? The crypto stuff. Yeah, kind of like that. But I'm sort of waffling here. But to make it short, I think we have a correction coming up here in the second half, and it's healthy. That'll help to reset things. But the bond market, the 10 years gone from 3.5 to 4 very quickly. So a lot of bond guys got pushed off sides. And, this isn't new. People that know me, I think corporate credit markets are set up for, can I say failure? That's a bit too extreme for Rich, right?
I don't like extremes.
Yeah.
I'm gonna disagree with Keith and yet somehow come up with the same conclusion, which makes me a little uncomfortable. But I mean, I don't think it was just a liquidity issue that propped up markets and brought them up to, from 3,600 to 4,600. It was also a massive massive revision of the earnings of these companies and the tech sector. Why? Because they have extreme operational leverage, and they were able to cut costs significantly in order to sort of improve their earnings prospects long before the AI stuff came out. So that's sort of my view. I also think that there are certain parts of the equity market that have done well because of massive deficit spending and infrastructure. So I'm not allowed to say single names, but let's just say some heavy industry companies have actually done really well on the back of massive spending. But where I then agree with Keith is actually a lot of this stuff is coming to an end. You're starting to see sort of that impulse sort to roll over, where you're getting weaker revisions. A lot of this spending stuff has already come through and been priced in. And then looking ahead, I sort of tend to agree with Keith, but we got there a different way.
So speaking of earnings, can we go to the Canadian story now? Can we do that, Steve?
Definitely.
Yeah, we got I mean, it is a Canadian show after all. So Keith,
I know,
take it
like
away.
we've been, talking about pandas and ninjas and fish and
Alligators.
Rich waffling around on something. And I still don't know what happened on the date that it didn't, I don't know why that didn't go well. Or not as well as you wanted. Okay, everyone, we're getting close to earnings season coming out. And what is probably like the most popular Canadian retail brand?
I dislike these guys.
What? It's a great store.
They suck. It's a horrible store. Anyways, go
disagree.
on.
So which company are we talking about then? You didn't answer the question.
It's Canadian Tire, everyone.
Canadian Tire. Yeah.
Funny
Canadian
money.
Tire.
I
Anyway,
love that. I collected that shit as a kid. Anyway, carry on. Sorry.
I'd have to go through Rich's photo album when he was a kid. When we get to go with your mom next, we'll do that. Maybe at the next live event, we can put the photo screen of just Rich's life. Anyway, everyone, this morning, Canadian Tire, back when I was working, as I'm still working now, but, back before everything became you had to be nice about everything. This morning, Canadian Tire did a good old warning. They came out years ago. They said, guys, we're going to be really bad with our earnings coming up, and so bad we don't even know what to tell you. So that's what a warning used to be like when I was younger. This morning, Canadian Tire announced we will withdraw financial aspirations going forward. What the heck?
That's an amazing euphemism.
I know. It's just like, you got to be nice all the time. And however, the market, of course, reads withdrawing financial aspirations as we're warning. We're going to get clobbered on earnings. So the point is, everyone, a lot of companies, they will give guidance where they expect their business is going to go into the future because they have better visibility than anyone else in their business. So usually your guidance reflects your top line growth and as well as your margins and things like that. So a company can usually say, yeah, we expect to be within this range, and that's where they usually end up. And then you might hear sometimes a company, when they'll announce their earnings, they'll surprise on the upside, or they beat estimates, or they raise guidance going forward. That language. Nope. Good old Canadian Tire this morning, they withdrew financial aspirations. Now, what's interesting, of course, the stock got mullered. The stock's down pretty good there. But the reason for, and this goes into what we've been talking about now a little bit, they reference specifically the current macro environment and consumer demand differs significantly from their previous outlook. So from a retail perspective in Canada, I know you can make an argument, whatever story you want to choose and stuff like that. But here's, a good old Canadian icon that sells stuff everywhere across the country. Are they in Kitsilano, Steve?
There's
Do
one.
they have space?
There's one about 3 minutes from my house, actually.
Yeah. And do you go there every day?
No, I hate that place.
Oh man, that's by the way, our new advertiser this week is not Canadian Tire, apparently.
I really like Canadian Tire.
We've got a Home
I do
Depot.
too.
I've got a Home Depot like right next to Canadian Tire, and it can't compete.
So when I was a kid, I used to go there with my dad. He'd go and, looking for stuff. I'd say, I'm going to the hockey aisle. And I go down and you take down a stick and a ball. And then
Yeah,
another
of course.
kid you start playing hockey in Canadian Tire, right? And it was no big deal because you couldn't break anything. That's the way it was. But anyway, so that's interesting. Like that catches my attention. Is it Canadian Tire specific? I don't know. We'll see as we continue to go on here. But it is a bit of a sign that, maybe the economy is getting a bit softer here coming up. And then we had another interesting sort of industry specific.
Yeah, let's there's a couple.
Do you want to go into that one or say Canadian
Tire? There's a couple comments on Canadian Tire here just from their guidance here. So they said, quote, the cumulative effect of increasing inflationary pressure and higher interest rates on consumer spend and financing costs, along with higher inventory costs, has significantly impacted the company's ability to deliver against its previous expectations. Given the slower pacing of growth and the noticeable slowdown in retail sales during the second quarter of 2023, company is withdrawing its previously disclosed financial aspirations.
So that's the best euphemism since rapidly unscheduled disassembly.
So yeah, stock's down 5% today, but just to kind of note on that. So Canadian Tire, I don't know, you know what's funny is actually, I feel like a lot of people don't know this. Canadian Tire actually, like one of their core main businesses is actually credit cards.
Yeah, but a lot of retailers are like that.
Yeah,
it's a similar situation to auto companies.
Yeah, exactly. A huge driver for Canadian Tire is actually credit cards. So if you talk to a lot of like the US sort of like hedge fund guys and stuff, and I've had a number of them message me over the years, just, chatting about, the shape of the Canadian consumer is they'll always have a keen focus on Canadian Tire. They view it as sort of a bellwether for the health of the Canadian consumer. So, I mean, just an interesting anecdote there. There's an
interesting anecdote for you as well. So that Starbucks the other morning, I'm getting coffee, and I had to load. Mrs. Icecap might be listening, but I had to put money on my card, like on the app, because it got wore down. So I put the money on, then I turned my phone around to the guy, I can scan it, and this guy says, "You put $100 on your card?" He said, "What are you, rich?" And I said, well, I have some success, but I don't know if you call it.
As a matter of fact, I am rich.
You're rich.
Is that the new barometer? If you got $100 Starbucks card, you've made it.
Apparently so, but it is an example like that credit card world. I think the Starbucks cash balances on that platform. Maybe some of the readers or some of the listeners can help us out, but it's actually hundreds of millions, or maybe into is that 9 figures or 10? Where do you get to $1 billion, Rich?
I don't know. I don't know anymore.
Hey, Rich.
I mean, let's get away from the single name stuff in case someone's listening. But like, I think what Steve mentioned, which is really the point here. It's about try to look at sort of non-linear indicators about what's going on in the Canadian consumer. And there's a couple other companies that I think fall into this category. So Canadian, when you're looking at the index, there's 10 or 11 sectors, depending on what you're looking at. So it's, and there's real estate, there's financials, there's industrials and whatever. And Canadian Tire falls into what's known as consumer discretionary. So there's consumer staples, which is staples, things you need, bread, milk, I don't know what, lemon loaves. And then there's consumer discretionary stuff, which is things that you would do sort of with your extra dollar after you deal with your utilities or your energy or your, all of the basic stuff that you need to live. And Steve mentioned this a couple of weeks ago, I think, about how his friend, had a massive increase in their debt servicing bill, and how there might be sort of a knock-on effect of that squeeze, or that increase in sort of in a number that you can't escape, and how there would be a pressure on sort of the discretionary spending. And one of the main beneficiaries in the Canadian economy might be for example, Canadian Tire, or, restaurants that, you might go to, or what have you. And so I think it's really interesting as we go forward to sort of pay attention to what Steve mentioned, which is what people are, how are people getting squeezed, and what they're doing with that extra dollar as it dwindles. Steve, is that a fair characterization
but I mean,
of what you said?
For sure. I mean, I think it doesn't take a genius to figure out that, when you tack on 500 basis points to someone's mortgage, that they're going to have to start cutting spending somewhere else in order to service that mortgage. And I think it's just taking time for that to sort of show up because there's a lag effect. I think, Rich, you've been following this, which is, credit card balances, not only for Americans, but particularly for Canadians, is growing at a very rapid pace. And I think that's kind of like the last sort of hope for Canadians, right? Which is, in order to sort of maintain their lifestyle, they just start accumulating credit card debt. And, I've had family that personally has worked in the consumer insolvency business for decades. And so, it's always been in the back of my mind, just hearing conversations about how a lot of people live their lives day to day, which is they will grow that debt and they will keep growing that debt until basically it becomes insurmountable and you can no longer pay it back. And then that's when you go for help. Is they don't reach out to these, consumer proposals, bankruptcy people, until the problem is so far gone that there's no repairing it. And so, yeah, I would say the typical Canadian household is not necessarily proactive with their finances. We run a macro finance show here, but I can tell you, like, the people that are listening to this are probably in the minority of Canadians. I think a lot of Canadians, don't care about finance and macroeconomics and maintaining a healthy balance sheet. And so, I just think it's going to take time, and I don't think it takes.
They might not care in an implicit way, but they do. Sorry, they might not care in an explicit way, but they do in an implicit way, which is to say that and this reminds me of something we've never talked about on the show, which I don't know how we haven't, which is the wealth effect, which is, or maybe we've mentioned it once or twice briefly, but like when you see your house price going up every year 5, 10, or 15%, even though you don't note it down in like a balance sheet or a checkbook or whatever Keith uses, but you definitely you feel richer, and as a function of feeling richer, you're more confident in spending money and borrowing, even though necessarily and so what I think is, for the first time in a while, Steve, you've mentioned that house prices have actually fallen significantly. I understand the distribution is different across different cities and jurisdictions, but you're seeing and hearing talk of house prices falling, and that wealth effect, again, implicit in people's decision making, is that it's now not as strong as it was, let's say 5 or 10 years ago. And I think that that's something else that's affecting people's decision making. Steve.
Yeah, just to add to that, I mean, if you're a Canadian household, right? So if you've seen particularly over the last 5 to 10 years, you've seen your house prices grow exponentially, and you've had an ability to actually tap into a lot of that equity at very, very cheap interest rates, right? I mean, you could refinance and you could, pull a bunch of new cash out, and, your mortgage would be 3% or 2.8% or whatever, something incredibly low. Or, you'd tap it on a home equity line of credit at, 4.5%, very, very cheap money. Well, again, today, if you're like looking to spend and go buy a boat or a new car, well, it's like, are you really going to refinance your home at, a 6.2% mortgage rate, or a home equity line of credit that's 7.5%, getting closer to 8%? I mean, it's a very, very expensive money. And so the ability to sort of tap in to that housing wealth, I would say, has also been tightened significantly.
There she was. Gone.
Keith?
Well,
Keith,
I think
refinancing the home to buy some more lemon loaves.
Yeah, no, be a big lemon loaf, one big one.
One big one.
I think, though, what sort of ties into this next is this morning, RBC, their analyst strategy, side of the investment arm, they come out and they actually cut their earnings estimates for the Canadian banks coming up. So Canadian banks' earnings are coming out, in the, say, August 24th, 23rd period. So we're getting there soon.
Is this guy getting fired?
You could. You know, you never talk about that club, but this guy did. But the reason, you know, I mean, we've been talking about this earnings season coming up now for a while, since the last one, I guess, because we want to see what's happening with the loan loss provisioning. And I suspect on this quarter coming up, it'll be probably in line with last quarter. Like there may not be, you know, too much of a switch. But the reason the analysts cut earnings estimates for all the Canadian banks was due to M&A, so merger acquisition, investment banking type activities. And they just say, you know, the number of deals are down and stuff like that. But that also provides another clue about the economy. So when there's less M&A, there's less IPOs and things like that. And that signals there's less confidence in the private sector that, hey, like, yeah, we should do this deal, or we should, you know, raise this capital, you know, to take advantage of this or that. So my point is that we're starting to get little pieces of the puzzle. You're putting them all together. And it doesn't mean that, you know, as Rich correctly said, it doesn't have to be, you know, this boom or bust scenario all the time. But, you know, we continue to expect the economy is going to soften. And you hear Willis then?
We heard him.
Yeah,
I heard him.
There's someone out there, but that's what we suspect is going to happen.
He agrees with you.
I think
He's going to go punish Willis.
I had a good conversation last night actually with a good friend of mine. He's very, very active in the commercial real estate space. So he works for one of the largest sort of companies or institutions in that space. And, you know, he's a deal maker. So he's pounding the phones every day. You know, he's getting all the volume that comes through. So they see a lot of different avenues. And he was just like, yeah, like deal flow is almost non-existent. So, but he's basically saying like the bid-ask spread between you know, buyers and sellers of these institutional assets is just enormous. Like sellers don't want to budge. Buyers are like, well, hey, listen, the cost of capital is up, you know, whatever, 500 basis points. Like your cap rates have to come up. But nobody's moving. And it's a little bit like that in the residential space, but like more so in that space. And I just look at it and say, you know, you think about all that economic activity that's basically not happening as a result, right? Like, I mean, you know, the brokers aren't getting paid, the lawyers aren't getting paid, you know, the contractors that might come in and rehab these buildings aren't getting the work, the governments aren't receiving their tax revenues or tax receipts from the capital gains of these properties or the transfer taxes that are involved in these massive sales. And so you're just kind of have this standstill and this standoff, where, you know, prices obviously haven't cleared because there's no transactions happening. So yeah, is your friend
sorry to interrupt. Is your friend in Canada? Is your friend in Canada?
Yeah,
sorry.
Yeah, he's in Canada.
Okay, sorry.
Yeah.
Sorry.
They're very large company. I won't say which one, but
the challenge we have with an open economy and capital markets and everything, an economy can't operate in, what do you call it, stall speed? You know, you're just hovering.
Yeah.
You're either accelerating or decelerating. That's just the way economic activity works. And we are going in the opposite direction. That's where we're going. And you know, I just saw like a story popped up on my screen then, Guggenheim Partners. So that they're an American, what would you call them? Private equity, deal making type. Now they're warning that credit, it will be the next shoe to drop if a shoe drops. And that sort of goes in line with what we've talked about as well. So anyway, we'll see where we move along here.
The dog
Steve,
days
can I
of
ask you
summer.
a question? Steve, can I ask you a question just before we go? Did he talk to you about occupancy rates? And do you know anything about that in the commercial real estate space?
Didn't get too deep into the occupancy rates. Obviously, office we still know is struggling, but you know, multifamily apartments still holding up well. You know, industrial still looks okay. So, yeah, I don't know. I think that just in general, just the dog days of summer, Keith.
I got to end with one like community announcement.
Uh-oh.
Say no to central bank digital currencies. I didn't talk about it today, but I just want to make sure people don't forget.
I love that. We should conclude the Loonie Hour with a PSA every week about the central bank digital currency.
That reminds me. I don't know if you guys have been Keith doesn't have Instagram, but if you've been on Facebook or Instagram and you're looking for
I don't have the Facebook either.
Yeah. If you're looking for your Canadian news content, it's now been basically removed or hidden by Meta. Of course, that's we had Professor Michael Geist on the show who warned that this was going to happen, which is the Canadian federal government here has shot themselves in the foot by inputting this. What was it? Was it Bill C18? C18. Yeah, so Bill C18. It's funny because I have a bunch of my friends. They're like messaging in like the group chat. They're like, why the hell can I see my like Daily Hive Vancouver like it's saying it's blocked? Like it's funny because like most people aren't even aware of like this bill and like why their news feeds are now being blocked from seeing this content. But you can actually thank your federal government for that. This was totally foreseeable, as Professor Michael Geist mentioned in our episode, that this would happen. So I don't know how these Canadian news sites are actually like, what happens there? Because like I was trying to think about it the other day.
It hurts them. It hurt. That's the they're doing this. Anyways, go listen to the website. But I have a friend that specifically their job is to handle the company's Instagram, like social media. Like that's what she does. And so it's like, yeah, I'm like, that's interesting. Like, does she have a job? Is she like relevant anymore? Because like, she's out there posting on Instagram, but nobody can see the posts.
Rich is wondering if she's single.
Oh my God.
She's not. Sorry, buddy.
Steve,
my hot take.
Whoa. Yeah. Steve, you saw another interesting story that came across your desk. It originated from Nova Scotia, but I think it also popped up in Toronto as well. About how is
that was me.
So it started with that was you, Rich. You can launch with it then.
Oh God, I have to bring it up. Basically, the Nova Scotia minister suggested that that homeowners in Nova Scotia should open up their homes. Apparently, there's 130,000 unfilled bedrooms in Nova Scotia, probably one or two at Keith's mansion. And he was suggesting that people start accepting new entrants to the province in their homes.
City of Toronto, the mayor also said that the people need to open up their homes to all the refugees and immigrants and stuff that are coming into the country that are living on the streets.
People do that already, by the way. People already
I know, but it's
immigrants and refugees and asylum seekers, and power to them. It's not the same when it's just a random
Keith, you got to there you go. Open up your bedrooms there. Let people in for the pizza party.
So what catches my attention with this, and again, we're not trying to be insensitive or anything with it. I think it's great that governments are saying this because they're trying to find a solution, to the challenges we're having. However, the solution they're offering, they're just treating the symptom. That's it. There's a lot of other things going on with this. And then for the one thing that I see, like this is another opportunity with government. They want to get into your home. Are they going to start auditing your house to say, hey, that bedroom is not being used, or what's you have space here. You need to do that. And of course, you go around to that central bank digital currency and social credits. Yeah, it's true, Rich. Rich is okay because he doesn't have an extra space now where he's living. But if you do get one soon, then you'll have to open up.
I don't know if there was a lot of validity. I don't know if there was a lot of validity to it. But the city of Vancouver, for example, has an empty homes tax, which now I know Toronto has recently adopted. So again, if you have an empty home that you don't rent out for at least 6 months a year, you get slapped this 2 or 3% annual tax. But I believe in Vancouver under the old mayor, I actually believe there was ongoing conversations. I don't think they actually got serious, but there was conversations, I believe, about an empty bedroom tax as the next progression. And you can see where this is this slippery slope of telling people how they should utilize their homes. And anyways, this is probably a little bit more of the tinfoil hat stuff that we don't need to get into at the end of an episode. But to Keith's point,
But it's not a tinfoil hat. It's private property versus the government telling us what we should be doing with our properties. And again, they're not coming up with a solution. They think they are, but there's a lot of other things that could be done as opposed to scurrying around like that. Maybe we're not making any friends this week. We'll see.
The animal kingdom is definitely a big fan of the Loonie Hour right now, because I think we've made 6 or 5 animal references. Next week, we'll try to beat that record.
The fish in the room.
The ninja in the room.
That's a good place to end it.
Yeah.
As always, guys, appreciate your support, and we'll see you next week.